Alrighty, what is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to do some stock analysis for Hims and Hers Health because this stock is reporting earnings in a little bit over an hour, and I had somebody else ask me about it earlier this morning, so I just want to do some analysis to see where we are at with this stock. This stock, over the past couple of years, has had a ton of volatility, and since the beginning of this year, it's recovered a lot. It was at $15 at the beginning of this year. Now we're at $31. And we're just going to see what's going on with this company, where's the valuation at, and what is my plan for this stock. So, the market cap on this is $7.5 billion right now. If you don't know, they are a D2C wellness brand that specializes in different personal care products like hair loss, sexual health, dermatology, mental health, and weight loss. They connect patients with licensed healthcare providers via an asynchronous telehealth interface, delivering prescription and over the counter treatments directly to their homes. They operate primarily on a recurring subscription model, providing high revenue predictability and strong lifetime value per user. And that is a valid advantage to this business model. They operate affiliated compounding pharmacies and fulfillment facilities, allowing the company to synthesize custom formulations, which means combining multiple active ingredients into single daily pills at low unit cost. So that is fantastic. I think you just have to always ask yourself, is this something that is easily replicated, and are there other competitors doing the same thing? Which in this case, I think there is. For all those different, segments that they operate in, there's going to be competition there. And so it's really just about, are customers loyal to this brand? Do they have good pricing? Do they have good customer service? Do they have something that sets them apart? And what's the future look like for that? Like, how much can they really grow? Which brings us to their moat. So they excel at marketing sensitive health conditions through modern consumer centric branding that lowers social stigma and drives high organic customer acquisition. By offering customized dosage combinations that retail pharmacies cannot provide off the shelf, they build switching costs. Patients who find a tailored pill combination are less likely to cancel. And that's all that's a great point. That's definitely them taking a step further, but at the same time, could somebody else do that? Yes, probably. In-house fulfillment and compounding infrastructure create cost efficiencies that allow them to maintain 80+% gross margins, which let's quickly glance at where their margins have been the last couple of years here. Go over to gross margin and we see, big time slowdown these last couple of years, but it peaked in 2023 at 82%, which is phenomenal. And now we've come all the way down to 50%. So not sure exactly what's caused that, but it's definitely not good. Which it very well could be because of competition, to be honest. ROI was just negative, so the business has really gone downhill over the last year or two. And we could even, let's see, profit margin negative. So that's really what investors are probably going to be watching when they report earnings today, because that's a big, they backtracked big time. So definitely going to want to see what's going on with that. What is their growth drivers? Well, obviously the weight loss and GLP thing that's been going on the last couple of years, that's been huge. But again, there's competition. Offering compounded and branded GLP-1 medications have opened a massive TAM, accelerating top line subscriber growth. Okay, so if that's the case, then why has their margins gone down so much? So total subscribers is at 2.5 million, very solid. Revenue has, again, these past quarter or two, not much growth there. The good thing is that they are projecting 30% growth this year, then 36% growth next year. Those are very strong numbers. That I could easily put a 30 or 40 times PE on the stock then. So there's that. Monthly revenue per average subscription, we're looking at $80, which again, so why is this? They must be heavily spending for marketing and stuff, because as of last quarter, it was $80, which is that's very high prior to where it was in 2023. So that's kind of odd. They must be spending a bunch of money to get that. Where's their expenses at? So let's see, research and development, capex. So we definitely see, yeah, sales and marketing has definitely, yeah, that's what it is. Sales and marketing has grown from 400 million a couple years ago to now over 900 million. So they've more than doubled their capex on, well, really their sales and marketing spend. And Revenue since then has gone from what, a billion to a little over 2 billion. So they're not real. That explains why there's not much profits rolling in. They are expanding into cardiovascular health, hormone therapy, broader longevity solutions, and with all these different things, is hair loss, sexual health, GLP-1 and weight loss. All these are things where there's always going to be a market for that. There's always people looking for those products, and even if there's three or four competitors, there's still going to be business. So, I mean, this is something where I could see even with competition, even if you don't have a huge moat, I could see you're still able to grow. They're expanding into European markets. Okay, that's always going to have a nice addition to growth to it. And what are the risks of this stock? Number one, GLP-1. GLP-1 regulatory risk depends on the FDA shortage. If drug shortages end or rules tightened, that could whatever affect revenue. Direct-to-consumer health models face ongoing customer acquisition costs, like we just saw. Maintaining long-term subscriber retention is critical. They have the base case at about $35, so we're almost in the base case. Though they have the bull case at $50. Okay, and then they have the bear case at $20. So it's it's pretty fairly valued here. I mean, like I said, I would easily put this at 35 times earnings. And if you take next year's earnings, $0.62 EPS times 35, that puts it at a $22 stock, which makes it kind of look overvalued here, but really, I mean, they are growing 36%, and this they could come in and report 80 or 90 cents of EPS, even a dollar of EPS, right? And then the stock doesn't look that much overvalued. So that's all it is. I mean, people are going to be paying attention to what are the margins, what's their capex, and what's their guidance for the next quarter and for the rest of the year. That's what people are going to be paying attention to. So it really depends on that. But when you look at the valuation, obviously we can't use price to earnings, but if you look at the other valuation metrics, free cash flow yield is only 1%. That's pretty low. And then price to sales is a 3, which is also significantly lower than most other stocks, especially one that's going to be doing 30% revenue growth. So you especially look at the last couple of years. The price of sales has been anywhere from a 1 up into, 7 plus. So I would say a fair valuation is about 3 times, maybe 4 times sales. And the other thing is what's their margins? That's always going to play a part here. So it looks like they are going to break into profitability starting next year. At least that's what's projected. Well, I guess they had a positive quarter or positive year last year, but this year is going to be negative. And let's look at their net income real quick, because they sure have some weird up and down profitability here. So we see 2024, they had a spike in net income. Then it shrunk in 2025. 2026, it's negative now. Free cash flow all over the place. So see, I already don't like that it's so inconsistent, and in that's gonna automatically bring the valuation down a little bit because it's unpredictable. It's not consistent, and if you report whatever 50 or $100 million of profit one year, and then a quarter later you're losing $100 million, well then it's like, okay, we have to value this business a little bit differently. So that's the only issue there. But in terms of valuation, it's really not bad. Price to sales of 3, totally healthy, totally fair. And 70 times earnings is not cheap, but like I said, this is a very volatile stock. There's a huge swing in earnings here, and they could easily come in and beat this at 90 cents or something like that. But anywhere around this stock price, I would say is fairly valued. So that's the way I see it. Again, well, depending on what they do for guidance and stuff, that could cause a massive swing in the stock. If they say our margins are still getting worse and we're lowering our guidance, well, then this stock could go back to whatever. It could drop 20%. So that's the way I see it. I'm not going to be buying this though. It doesn't interest me enough. But that is my analysis for hims and hers. Let me know what you guys think down below, and I will see you in the next video.